Good morning. Welcome to Stock Market Today, Tuesday, February 23rd, 2021. I'm your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for that free email where I get a lot of the content for this show. We also give you stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities mostly lower in Monday's trading and closing near the lows of the session. Growth to value shift was in full force yesterday as rising rates have begun to weigh on the growth theme. I started to highlight this in my notes last week, the lift in rates and what that could mean for growth stocks, high multiple stocks, etc. Treasuries were mixed with weakness at the back end, causing further steepening. So that's also another issue that the growth names are going to deal with is the curve steepener. It's positive for the financials, but not the best look for high multiple stocks with earnings on the come. The dollar was weaker on the major crosses. Gold actually rebounding up 1.7%. Remember our chart from yesterday with gold holding support. WTI crude up 4%, closed near the best levels of the day. Your outperformers yesterday, energy, financials, REITs, materials. Your laggards, tech, discretionary, and utilities. And as we get to the desk this morning, futures down 50 basis points on the S&P. NASDAQ futures down about 1.5%. S&P is down 5 days in a row quietly. Asian markets were mixed overnight. Japan was closed for a holiday. European markets are weaker. Treasuries are little changed. Dollars bid against the euro and yen. Gold off 10 bips. Crude oil up 80 basis points, following through on that rally from yesterday. And as we think about high multiple stocks and interest rates, you know, everybody has been enamored with the ARK products. And just take a look at ARKK, their flagship product for the most part, down 10% in 5 days, right? If you think about the holdings within that fund, names like Tesla, a lot of high growth names where, you know, the big part of the earnings cycle is on the come, higher rates do not mix well with those stocks in the near term. And you're seeing it. I mean, in 5 days, Tesla's off 13% and more to come this morning. And the ARK Innovation Fund, ARKK, is down 10% in 5 days. So just a little thought process there on rates. We're going to hear from Chairman Powell today. He's in front of Congress. It'll be interesting to hear what he has to say. And here's the structure of the market. So the shift is on, growth to value. Notice small caps have held up better here. Trend is still up until proven otherwise. Our support levels are where they are. We actually bumped up support yesterday for SPY. We bumped up some support for the Qs. We'll see if they hold. Watch that 315, 320 level for Qs. Watch 370 to 380 for SPY. IWM solidly above near-term support. IWM, part of the rotation trade. I mean, in the small cap space, there's a lot of energy. There's a lot of banks. It just is. And you're seeing the rotation. So we're going to watch rates here. The structure of the trend still in place, but you know, the roadmap, the levels. Is your risk management process in place? If you have a portfolio full of growth stocks, are you getting or is your process triggering? Could be. Could be. I know I'll be taking some exits this morning. Process. I don't know how it's going to play out. Things could always stabilize, re-trigger, and you can get back in, but you don't know. We don't know what Chairman Powell is going to say. Now, what I will say is the 10-year starts to run into some resistance around the 14815 level. So we'll have to see. The Fed chairman has stated numerous times that the policy will remain accommodative. So we'll see if they step in. Dow closes higher. Investors flee growth for value. That is the theme. I mean, just the fact that the Dow was up yesterday, it really shows you your theme here. I mean, the picture's painted. Materials, industrials hold relative support levels as financials break above key resistance. Technology under pressure as rates rise. We've talked about that, and futures do point to a lower open today. Taking a look at the power bars now. Some deterioration, 9 to 5 bulls to bears for the Dow and an up tape for that index. S&P 500 loses 0.75%, 148 to 52 bulls to bears there. NASDAQ 2.5% to the bad, 26 to 13 bulls to bears, so back down to 2 to 1. Small caps, actually a little bit of deterioration there as well. They were an outperformer. Bonds down, take energy, your best group. We've talked about it. According to the Chaikin Power Bar, small cap stocks and large cap stocks are strongly bullish. Major indexes are mixed. Stocks of the day, let's run our screen. So what do we have? We have the high multiple names getting hit as rates lift. So what I did was I said, let's look at the Russell 3000 for bullish and very bullish stocks, but that have bullish valuation factors. So, relative to their peers, relative to the market, price to sales is bullish in our model, and projected PE is bullish in our model. Now, at the same time, given the overbought nature of the markets that we've been talking about, not a ton of names are overbought. So what I asked for was, give me the names that are below their 21-day EMA, but above their rising long-term trend line. So a little bit under pressure in the near term, but still very much in a long-term uptrend. And then obviously we want Chaikin money flow and relative strength to be strong. That screen returns 10 names. So surely manageable to do some work if you're so inclined this morning. The 10 names are here. Feel free to take a snapshot. Feel free to write them down. I'll leave this slide up for just a moment. But it's interesting because it's a lot of what we've been talking about, broadening out the view, right? A more balanced approach to the markets. We've been writing about it, talking about it, right? Broadening out of participation. I think it may, if at this, if you had a portfolio that was 100% levered to growth, tough. Didn't need to be that way. There was lots of opportunities. We learned from it and we continue to move on. But take a look at these 10 stocks, maybe some opportunities there if it fits your process. Let's look at our sector tracker now. Moving to the last 5 days of trading. Energy, fins, materials, and industrials are higher, right? Okay, that's your cyclical rotation right there. It doesn't get clearer than that. What we don't love seeing is the next two as REITs and staples. Even though they're down, they're outperforming. That's defensive. We really don't like seeing tech at the bottom, but we see it's there. It just is, right? Rates are going up for now, and that's going to impact tech. Just think about discretionary. The two biggest names in discretionary are what? Tesla and Amazon, or Amazon and Tesla, right? High multiple names. Gonna be tough for discretionary on a cap-weighted basis to do well in that environment. So we're going to watch rates. Rates are the key right now. Our industry in focus, speaking of tech, semiconductor services. Past 6 months, monster outperformer, 43% against the SPY. Power bar ratio, very strong, 13 to 4 bulls to bears. But currently ranked number 13 of 21 subsectors. Actually moved down 9 slots over the past week. So let's notice how tech is coming off. And I want to show you something interesting. Now, semis continue to outperform, but it's the pace of outperformance that really starts to become key. So, Intel, Micron, Qorvo, all very bullish, all holdings of the fund. Now, the fund looks great, but what we want to watch is the relative strength. So the relative strength is still positive, but rate of change is going to matter. Now, remember in August, semis were outperforming, but at a declining rate. And they maintained their outperformance, but the intensity of outperformance was diminishing, right? So they were outperforming at a declining rate, right? So rate of change. And then what happened? S&P, go look at an S&P chart, September, October, November. Choppy, some pullbacks. Okay, so this rate of change matters. So we want to watch this here. It's not a total shock, given rates rising, and you're seeing a little bit of a rate of change here to the downside in semis. I think that's important. We're going to watch that closely. If semis break down, we have bigger issues. But if they just kind of outperform at a declining rate, potential there for some choppiness like we saw in the September, October, November timeframe for the S&P 500. Keep an eye on it. Taking a look at what's trending now. Yesterday's movers and shakers. PBCT being bought by M&T Bank. Royal Caribbean earnings. AAL upgrade at Deutsche Bank. Venero, VNO. Positive comments on their earnings call. So Royal, American Airlines, and VNO, all part of the reopening type plays. Disca earnings sent that stock higher. Loser side of the board, nothing company specific other than NRG, which is rescheduling their earnings date. Enphase, Tesla, Teradyne, kind of high multiple stocks that have moved a lot recently. So some pressure there. VTRS, didn't see anything company specific to drive the trading in that name. So just now we're back to the macro. Right? Earnings season is pretty much done for the most part. I think over 80% of the names in the S&P have now reported. So we're back to macro. So the intermarket themes, relationships, analysis starts to become important. Speaking of, right, rotation, cyclical reopenings, things of that nature. Now, remember back in June, we talked about June, July, we were talking about materials and industrials. Materials in the June, July timeframe, industrials kind of back here in the summer, right? They've been outperforming. Then they came under pressure, but look what happened. Both of these now pulled back to their rising 200-day, which held as support and then spiked higher. It's your shift. This is your reopening. This is your things are getting better. This is the global economy is improving. All the things that we've been talking about, all the reasons to have a more balanced approach to portfolio allocations, right? Because the opportunities have been there, and participation has been broadening out. So top chart is materials relative to SPY. Bottom chart is industrials relative to SPY, both holding key support levels at the rising 200-day moving averages. Now, financials, on the other hand, take out resistance. Look at XLF relative to SPY. We've been watching these levels, these two interim highs right here. Well, we took them out above the 50, above the 200-day. Confirmation from momentum with the RSI breaking to overbought levels, and really not it hasn't been over. This RSI of this relationship has not been oversold since March. Right? Series of, I could have drawn this line here, right? Series of higher lows, but you can see the turn, and notice how that turn is playing out as the 210 spread steepens. Bottom of the chart is your yield curve spread. There's different spreads out there. 210 is most widely watched here, and you can see it, right? So this is a boon for financials, especially banks, right? And we're seeing an acceleration to the upside. We're seeing rates move higher, and it's more pronounced. Now, we've talked about it numerous times. It's more pronounced at the back end of the curve. That's curve steepening. Curve steepener has been the trade. It's been the trade for a while, and whether you care or not about curve steepeners and the bond market, treasury market, it matters for equities, right? Which is why we pay attention to it. There's a reason financials are outperforming, and as this accelerates, there's a reason your high multiple stocks are getting hit, and it's right here. It's found right at the bottom of this chart. So that's fascinating. That's something we want to keep an eye on. And then here's tech, pulling back into the 5,200 buffer zone, right? Red line's the 50 moving average, blue line's 200. This is XLK relative to SPY. RSI of the ratio stuck in the middle of the range. Now, XLK is still above the breakout level at around 130, so we're going to want to watch that very closely. But on a relative basis, I mean, this has gone nowhere since September. Look at the curves in September. It's all connected. We're going to watch, but for the most part, high multiple growth stocks do not like rising rates. That'll wrap us up for today. Take us for a test drive. I'm back tomorrow.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.